Right now, the most valuable companies on Earth are racing to sell you their stock. The gates to the greatest technology boom in history are throwing its doors open, giving ordinary people a chance to own the future. But in the stock market, an open door is rarely a favor. Finance operates on a simple mechanic. Every trait needs a counterparty. If you are trying to buy a share, someone else has to be willing to sell it to you. In an initial public offering, the sellers are the founders, the early employees, and the venture capitalists. These are the people who funded these businesses when they were nothing. Nobody on Earth understands the internal data better than they do. They've looked at the numbers the public never gets to see, and they made a decision. They would rather have your cash than their own equity. If these companies are truly going to define the next century, why are the people who know them best in such a hurry to cash out? To understand how this ends, we have to look past the headlines and study the mechanical blueprint of how markets actually break. We have seen this exact pattern before. In the lead-up to the dot-com crash, the concentration of companies going public hit a record. In 1999, 51% of all IPOs came from a single sector, tech. It was the setup for a massive shift in risk from insiders to the public. Today, that setup is visible in the physical world. This year, the largest tech companies are on track to spend $725 billion building out AI infrastructure, the largest and fastest capital build-out in history. This massive spending creates a tell for professional investors. I call it the dine and dash. When markets are booming and capital requirements are highest, insiders look for an exit. They sell when the story is loudest and the optimism is high, because that is when they can get the most money for their shares. In June 2007, while Wall Street was booming, the founders of Blackstone took their firm public, walking away with $2.6 billion in cash. A little over a year later, the global financial crisis hit, and Blackstone's stock dropped roughly 90%. This pattern appeared again during the 2021 SPAC boom. Insiders listed 613 blank check shell companies, raising $160 billion from retail investors. Once the insiders were cashed out, the value of those companies collapsed, with average losses exceeding 60%. Historical bubbles collapse right after the smartest people in the room execute a coordinated exit. By going public at the height of the hype, they shift the financial risk of their massive bets onto the retail market. The reason insiders are looking for an exit is the reality gap between spending and earning. Against $725 billion spent on AI infrastructure this year, the entire AI economy generated an estimated $110 billion in revenue. For businesses using this technology, it's worse. MIT researchers found 95% of corporate AI rollouts produced zero measurable financial return. Despite these returns, the stock market has priced these companies for a future where every one of these infrastructure bets pays off perfectly. There is very little room left for good news. Look at OpenAI. Last year, the company brought in $13 billion in revenue, but its net loss reached $38.5 billion. Despite losing nearly $3 for every dollar earned, recent valuation discussions place the company at $150 billion, over 10 times its revenue. The current market has priced these companies as if the gap between spending and earning doesn't exist. Eventually, the fundamentals catch up. They always do. Tech founders and venture capitalists see that prices have moved miles ahead of the actual revenue. They know that an appetite for a bet with a slim chance of paying off can only last so long. The AI market is currently a multi-billion-dollar game of hot potato. The objective is to pass the stock to a new buyer before the music cuts out, and everyone knows someone gets left holding it, but none of them know exactly when the passing stops. In 2007, months before the global financial system nearly collapsed, Citigroup CEO Charles Prince was asked about the bank's risky lending. He said, "As long as the music is playing, you've got to get up and dance. We're still dancing." He knew the party wouldn't last, but he stayed on the floor to avoid being left behind. Because insiders know the dancing eventually ends, their rational move is to offload their shares now. They are handing them off to the largest, most enthusiastic crowd of buyers they can find, the public stock market. No one has a magic stopwatch to predict when a bubble pops. It could happen in a month, or the market could grind higher for another 3 years. You don't need to know the exact date of a crash to recognize the tells of insider selling. The goal is to read the room you are standing in, so you aren't the last one on the dance floor when the music stops.